So I'm going to take the opportunity to introduce the next session of panelists and our moderator. Like I said, the topic that we'll be discussing in this panel discussion is a status check and trends on newfound appetite for Indian realty, city scorecard, investing in residential, commercial, or the best of both worlds. Ladies and gentlemen, please join me in welcoming our panelists. Starting first with the Chief Executive Officer, Embassy Office Park, Mr. Mike Holland. Good afternoon, sir. Pleasure. Next, the President and CEO, Genkai Capital Management from Japan, Mr. Masatoshi Matsuo. Good afternoon. The next panelist joining us on stage is the Joint Managing Director, IRB, Mr. Sudhir Hoshing. The next panelist is the CEO, Private Equity Indiabulls Asset Management Company. Ladies and gentlemen, please welcome Mr. Ambar Maheshwari. Thank you. The next panelist on stage is the Portfolio Manager, Lazard Asset Management USA, Mr. Gautam Garg. Introducing next, the Director and Head, Motilal Oswal Real Estate, Mr. Sharad Mittal. The last panelist is the Chief Operating Officer, Radius Developers. Ladies and gentlemen, let's welcome Mr. Ashish Shah. And it's now time for us to introduce our moderator. He is the co-CEO Investment Banking, JM Financial, Mr. Atul Mehra. Would you please join me in welcoming the panelists and our moderator for this session? Thank you. So before I leave the stage to the gentlemen and the panelists, the JM financial officials are in the Gulmohar room till 5:30 p.m. today, and they are willing to discuss topics on NBFCs, housing finance, retail and affordable home loans, digital broking for residential units. Once again, they are in the Gulmohar room till 5:30 p.m. today. Mr. Mehra, I leave the wonderful panel to you. Thank you.
Well, good afternoon, ladies and gentlemen. We are here today to discuss a very interesting topic on the real estate and infrastructure financing. 12 to 18 months back, SEBI rolled out the guidelines for the issuance of what we call as REIT and InvIT, and we all thought that that was a great step forward. We believed it was a great step forward for one, the issuer, as they had an alternative means of financing their projects. From an investor perspective, we thought that it was a great opportunity to widen the capital markets and give a new product to the investor which could serve their purpose. However, in the 12 to 18 months time, we have had some hits and some misses. It's a time now for us to evaluate as to what has been the progress and what needs to be done to make this a superb product. Before we move forward, and as the panelists have been introduced today to you, we have people from the issuer side, we have panelists from the investor side, and I'm sure they're going to add their perspective to it. But before we throw the floor open, I just wanted to give you a perspective on the size of the opportunity or the size of the missed opportunity that we could be staring at. The REIT and InvIT as a product started in US almost 5 decades back. So it's not a new product. US has seen today a listing of almost 750 REIT and InvIT product, and the market cap of all the listed REITs is in excess of $2 trillion. So it's a very vibrant product. It's a very, very liquid product. So it's important that we capitalize on this opportunity back at home and make it a wonderful product for the issuer. On the other hand, while there have always been complaint about returns, so let me share with you an interesting hard statistics. REITs as a product have outperformed equity markets in US consecutively for 3 years and 5 years. If you take a data for 3 years and 5 years, REIT has given on a collective basis returns which are far superior than the equity markets. It's an important point, and I would urge everyone to make a serious note of it. Second, which is interesting, while we all talk about equity markets being on fire in India currently, and all the money channelizing and going into the stock market, if you look at pure index in India, which is Nifty or Sensex, for the last 3 years, you would have made only 11% if you would have invested in equity, a mere 11%. Second, if you would have invested in gold as an alternate class of asset, you would have been somewhere in the region of 1 to 3%, depending on the currency that you would have invested in. If you were smarter and if you would have invested through the fund managers in the debt side, your return would have been somewhere in the region of 9 to 13% over the last 3 years. If you were smarter and if you would have put your money in the mutual fund through one of the smart schemes, depending on your time of investment, but over 3 years, your average return would have been somewhere in the region of 20%. So we are not talking about returns which are multifold or far, far superior. We believe, based on the analysis that we have done, REIT and InvITs as a product can, over a period of time, because of the inbuilt features of regular, consistent dividend and back-end growth, can easily better the returns that I just talked about. I will take a pause out over here, and we will go around and take a view from each of the panel members as to what their views are. But to begin with, let's start with the one and only one issuer of InvIT. And Mr. Hoshing can share with us his experience of actually doing an InvIT.
Thank you. Yeah, it's a great feeling now that we have been able to make it a success. We have been trying to do it from somewhere September 2015, and we have gone through all the regulations required, and then we had a sort of non-deal road show and wanted to know how people would feel. So some of the points which came and some of the points which were missing, we started discussing with the government, and then they were quite forthcoming and resolved each and every issue, starting from, if you see earlier, there were hardly any chance of insurance company, mutual fund to come in, which was later allowed. So what question we were facing outside is, see, you have come here, but why your domestic people, they are not investing in it? So we also felt if there is a huge domestic demand, so that is what ultimately is required. Domestic demand has to be there, then there has to be foreign demand. So of course, we found that this point was very important. And then one more point which we always was asked is, as compared when we talk about an InvIT, which we did, compared to real estate thing, the major thing was the perpetuity of the instrument. So as real estate can give you that. So we had an idea that we started with some 9 road projects, and then initially the way it was designed, we could put 6 projects into that. And since we are, as IRB level, we are continuously doing projects and they're getting ready. And once those projects see 2 years of revenue, they can always come in. So they would really add life to the instrument, to the InvIT. So when we went out, we found that there was quite a good interest, but the questions were asked whether, how much you can say that this toll you're taking is, will be there, or government may anytime say, no, you stop the tolling. But there are a lot of clauses which are there in the concession agreement, which allows government not to take it back, especially for government of India doing national highway projects. They are coming up with a lot more projects, and then they cannot do such things. So there are a lot of discussions going on. Ultimately, I found that really it works on what the juice is there. So real numbers. So what was the return you are going to give to the investor? So and that return should be good enough for attracting insider as well, domestic as well as the foreign funder or the HLIs. So if you were talking about GSEC plus 5% or something like that, that type of return we thought would be good enough for both the teams. Whereas because they were having only 5% tax at the source, whereas in domestic they were, for HNIs they were almost at whatever interest portion is there, on that they'll have to pay the tax as per whatever bracket they are in. So the returns were very important. The asset size, asset class was very important. And how they have been performing so far in terms of individual asset as well as a group or as well as nearby assets where we could see the growth coming up. If there is no growth, so what we started telling people that, there was also a confusion whether where it will be put, whether it is a debt product, it's an equity product, all those things we went through. And then I started saying, see, this is sort of a debt product with a growth. So you have a good likelihood of getting, if I am telling that 9% would come to you, it's good likelihood that you will reach 9%. But then there has to be some risk for the growth which may happen, may not happen. So another 2%. So that's how when we went to the market, we went for around 12%. And it was, as you know, 10 times oversubscribed and was a very great success. This is before we could do the deal. And after the deal, there were questions which are now asked is, why it is trading low? So initially, if you see our HNIs have put in around 12%, around 20-25% HNIs were there. And the instrument was not understood very well. One thing is that everybody thought, there will be a first day pop-up or a 15 days pop-up, which actually everyone by now knows that this is not the game. The real game is the return, the dividend, the yield. It's basically a yield product. So it works on the yield. And and it came down to something like 102 thing has come to 92. And then when we first time we gave the return of 12.2% on 1.5 or around 45 days return, then people realized, and this number immediately came to 96, 97. So I'll come back to you on this more if you have any question later on. By then I can pass on to you.
Mike, would you like to be the next one and share your perspective?
Okay, great. Now I'm conscious that there are a number of, haven't counted, really smart people on this panel, smarter than me for sure, and we need to get through them all pretty quickly. Just as an intro, my name is Mike Holland. I look after a portfolio of commercial office properties that's known as Embassy Office Parks. It's between 20 and 25 million square feet, and we've got 170 plus corporate tenants. So when we come to conferences like this and we talk about REITs, it's often bundled into the same conversation as InvITs. And in around the table just before, we were trying to unpack why is that. Because they are two really different products, very different indeed. And it came out that really it's because the regulator has looked at both of them at the same time. But we have got a very different product. We're looking at a set of assets, a portfolio of office buildings that really is almost evergreen. When a lease expires, we renew it. We'll usually get a rental uplift. And so we're not a concession that at the end of a contract, our concession ends. The positive side for us is if that lease ends, we increase our rental. So maybe as we go through, we can unpack this issue about how do people see things as being different. We were also talking about, is REIT and potential REIT listings, is that really about exits or is it about growth? Certainly for us, we're looking at REITs in the context of growing the portfolio, growth capital at more efficient rates. And then kind of a third piece that I'd like to unpack, given the fact that we've got people on the panel from Japan, from US, from India, from Europe. My contention is that the Indian real estate sector is at a real cusp where it's both at a domestic level and an international level, it's becoming attractive for investors. So those are the kind of the issues I'd like us to perhaps unpack.
Thank you. Ashish, would you like to share your perspective as well?
Thanks. We are seeing so many changes in the capital markets as a country in general. More capital is attracted. How do we channelize? How do we create those asset classes? And I think real estate being one of the biggest, capital-intensive sector, it's fairly important, and it's high time. From our perspective, REITs is something, a channel that we are, all of us are eagerly awaiting. In our buildings, some of our developments, we need to strata sale to fund the development in flight because the construction loan is not adequate for the land. So to generate cash flows, we have to do strata sales because in India, there are a lot of customers who would like to own their offices, but it does not, lend that grade A where big office lessees want to cohabit with strata sales. So, we've innovated in that, lack of capital. So, it's very critical that a product like REIT comes in. Having said that, currently, lease rental discounting is working quite well, wherein a big chunk of future cash flow for a good developer grade A asset and reasonably good tenant profile. A lot of lenders are extending the rental period far longer than a conventional LRD. That makes the capital far bigger chunk of capital available upfront. REITs is another animal in terms of a steady stream of capital availability. So the sector, especially office developers, it's extremely, we eagerly watch this product to fructify.
So let me ask you another question at this point of time. Since you're a developer and you're from Bombay and focused on resi in a very big way, how are you seeing the FDI inflow or interest from the investors? And also perspective on the RERA, is it hampering your growth or making you grow faster?
So let's step back from one unit of Radius developers. If you look at this sector in Mumbai, I think a lot of development opportunities exist. We're going to see one more round of consolidation. So, good opportunities are available to us. Few names are able to raise capital, either to refi the existing lender in that project which is stuck for capital, and it needs a brand. So I think it's an excellent opportunity after the regulation that has come in. From FDI perspective, I think it's far more, we are having far more conversations with foreign capital. Nothing significant has yet materialized, but I think it looks extremely promising in the next 12 months, wherein people feel more confident when we are able to show underlying sales that actually things work, our business model indeed works, is when the capital will come aplenty. There are still issues, but I think the few of us who are concentrated on the last mile customers, embracing the change, and it's extremely hard, Atul. So, these are the things which will separate the so-called boys to men.
So having heard the issuer side of the story, let's hear from the investor as to what do they think about this product. So let's start with Gautam.
Thank you. As a global REIT investor, I'm very excited to see Mike here. You see, I have no doubt in my mind that the REIT structure is one of the most efficient forms of real estate ownership out there, period. There's way too many benefits, way too many advantages, a lot Atul highlighted already. I'd like to highlight 5 of those. Number 1, tax and cost efficiency. It is one of the most tax efficient forms of real estate ownership for an operator like Mike, and is one of the most income efficient forms of real estate exposure for institutional and retail shareholders. The second point is accessibility. So in my mind, real estate ownership through the REIT model is one of the most inexpensive forms of real estate ownership. Let me explain. So if you wanted exposure to a shopping mall in Gurugram, an office building in Bengaluru, and an apartment building in Mumbai today, what do? You raise lots and lots of capital, and you go about buying pieces of each of these property types in different property markets. The barriers to entry are way too high. If India has REITs, right? Okay. If India has REITs, sorry, I was a little excited. If India has REITs and you essentially can get the same exposure to different property markets and different property types by buying a single share in each of these REITs or multiple REITs. You could build a portfolio of REITs that'll get you the same exposure with immediate liquidity. You can get that exposure within seconds by buying a share on the stock exchange and sell that exposure within minutes by selling on the stock exchange. So accessibility is the second biggest factor. The third biggest factor is financial disclosure. So you see REITs, as Atul explained, is a model that's been tested and developed and honed and perfected over decades. So organizations like NAREIT in America, APREA in Europe, and now APREA in Asia have done a phenomenal job of introducing financial metrics that REITs are supposed to incorporate in all their reportings. And I feel those financial metrics allow investors and shareholders to pretty much analyze the financial health of these companies and value the underlying real estate way better than you can do in a private equity fund format or in a direct ownership format. So that's the fourth big point. The fourth point, is corporate governance. So the REIT model, through its inherent structure, I feel enforces much better levels of corporate governance than a regular company. There are usually limits around levels of insider promoter ownership, and there are usually structures around how the asset management contract should be structured to make sure that the operator's long-term incentives are aligned with those of the REIT shareholders. So, and we know, better corporate governance is better returns, period. I mean, there's no doubt about that. And the last one, and the big one for India, is institutionalization. When you introduce REITs in a country, you pretty much democratize the country's real estate markets and real estate players in an overnight fashion, because you're introducing the country's major real estate players into the REIT structure. These REITs are now part of a global REIT investment marketplace. That's a $2 trillion investment marketplace, as Atul highlighted. So you have immediately lifted the profile of the country's real estate markets by making it available over this globally well-recognized institutional and retail shareholder base. And that, I feel, in the long term, introduces liquidity into the country's real estate markets, and pretty much in a much longer term, if you take a much longer term view, is improved liquidity in the commercial real estate market eventually will lead to a better growth of the real estate market in the country, and eventually better growth for the country. So I'd just like to summarize, these points with the fact that, it's really exciting to see, government, regulators, operators, and bodies like APREA just come together and push through, the REIT legislation, because, it's going to be a really exciting thing for the Indian real estate market, but it's going to be an even more exciting thing for the global real estate market to be able to have Indian REITs as an investment option within their respective portfolios.
Thank you. So over to you, sir, to hear the Japanese view. And we are really excited, and we want to know how the Japanese investment companies and investors are looking at the REIT opportunity and the InvIT opportunity in India.
Right. My name is Matsuo from Genkai Capital, Japanese real estate fund company. When I look back the history of REIT, actually I'm an original member of APREA in Japan. Since I did 10 years ago, I did a REIT IPO myself. At the time, as you said, REIT is like a democratization of the ownership of real estate. In Japan, long time back, before REIT, all the office building is owned by a large corporation. I was actually working for a big company called Mitsui, Mitsubishi, Nomura. Those big companies monopolize all the big real estate. Especially the hard and big office buildings and so forth. But after REIT was introduced, it was democratized ownership. So even each REIT can bought by my grandmother can buy it for, instead of a pension, she can get at the time 5-6% of yield in Japan. And also, so then that is very popular in Japan. Japanese REIT has 20 years history, but it boosts after 10 years because of the democratization of ownership. And also, as you said, this disclosure of the information. In this country, probably big real estate held by wealthy family, and they don't disclose too much about how they run this business. But now, after the REIT, everybody can access the information, how much rental, how much of expenses, how much of the yield you can get. That gives a lot of opportunity for new real estate player. Actually, I myself, after the REIT IPO, I was start my own company and fundraising and a private fund company, which was available because of the REIT gives us the information as a private fund. If we invest in real estate, REIT is waiting for us to take us out as an exit. So which gives us a lot of new information opportunity, which is good for all the real estate capital market. And I hope that same things happen in this country. So I also, yes, expect about Mike's REIT IPO, very much so.
So we heard the foreign perspective, the US perspective, the Japanese perspective. Indian markets are also booming. And we have two players from the domestic market to share their perspective with us. So, Sharad, would you like to start first?
Hi. I think like Gautam summarized on all the benefits that REIT brings in. But one of the questions with which Atul started is that it's been almost 12-18 months that SEBI had kind of cleared whatever hurdles were there for REITs to come in. Two InvITs have come, but let me say that InvITs and REITs are very different product. I think we should not mix them up. So far, no REIT has come. And I think what we are missing here is the strength of the domestic pool of capital. If you see, things have really changed in last 12 to 18 months. There is a transition which is taking place from physical assets to financial assets. Just to give you some data points, the kind of inflow which is coming into equity markets, mutual funds have now a total AUM of 20 lakh crore, of which equity AUM is 7 lakh crore. Last month, they added 23,000 crore net. So month on month, they are adding this much amount. I also happen to meet a lot of HNIs and family offices. There is a serious lack of opportunities at their end. If you really see the physical assets, which is the real estate, they have kind of going out of it for last 3-4 years for various reasons. Debt instruments are not as attractive, and that's why there's a horde of money coming into equity markets. One reason could be demonetization, and this probably the activity, the whole transition can be one of the reasons could be demonetization. So I think there is a need of a product like this if it is priced right. And the most important thing here is the education. I think investors domestically needs to be educated. It's not an IPO wherein you get a pop of 35% on listing. It's a substitute for your debt portfolio, which is diversified and one can hold it for a long period of time. So there is a lot of interest from offshore investors, but I believe there is huge market domestically. Mike is the one who's going to get the first one out and will surely get tested this year. But I believe, just to draw parallel with what is happening in the equity markets, FIs probably are net seller this financial year, but the kind of DI money which is coming in, I believe same can be replicated for REIT, InvIT kinds of product as well. Ambar?
Sure, thanks. I think pretty much everything has been covered, and I agree with everything that has been said here. Maybe a couple of things that I wanted to highlight were, even from a domestic institutional market, so far, whether it is insurance companies, whether it is provident funds, pension companies, none of these have had access to a product which will sort of match their asset liability. Insurance companies underwrite liabilities which are 20, 30 years and so forth. And the only product that they have access to that can match it today is government bonds. Private debt market, corporate debt market in India is not very vibrant, right? So this is one missing link which a lot of insurance companies and pension funds will have access to. Provident funds will have access to. There is going to be a substantial interest, I think, that is going to come in from there to begin with. The government has, ahead of the issuance, already allowed all of these players to now invest into REITs as well. So I think we're all very, very eagerly awaiting, whether it is from an individual perspective or it is from an institutional perspective. REITs are going to be great, and I completely agree with Sharad. I think it'll take some time for retail individuals to understand and comprehend the product. Quite like what happened in mutual funds again. When the mutual funds was launched, it took about 10 years for people to come to a realization that mutual funds is probably a better form of investment compared to direct equity. And I think that time lag would probably be less in case of REITs compared to what happened in the mutual funds. The awareness will come in much, much quicker. And in any case, if you look at the kind of, the big middle that REITs provide. So on the one end, you have from the investment spectrum, you have high return, high risk equity, and then you have low return and low risk debt. REITs are somewhere in the middle. But again, what's panned out in the US, so Atul, just to sort of take your point further, you said 3 years REITs have outperformed every other asset class. I was reading a very interesting analysis from JP Morgan about US. And for the last 20 years, if you regress 20-year data, REITs have outperformed every single asset class in the US in 20 years. So whether it is a short-term 3-year time frame or you're looking at a 20-year time frame, REITs are emerging as the best performing asset class. So really speaking, low risk, but proportionally risk-adjusted higher returns compared to any other asset class, right? And I think that's pretty much what's going to be true for India as well.
So now that we've all shared our initial reaction, let's do some deeper soul searching. Sudhir, my question to you was, when you were on the road, while we talked about the domestic strength and the depth in the market, do you think domestic insurance companies and mutual funds were ready to accept the product? what was your experience? Or do you think we still need to do some more work with them?
No, I think they were ready. See, we went to LICs, we went to everywhere, other mutual fund and other insurance companies as well, private. But there was no regulation for them to invest the money. So once that was cleared, and that is where, see, as I said, we started somewhere in September, and we thought that by March of 2016 we'll be getting it listed. But we took it to March 2017 to get it listed. So almost 1 year, we were struggling to tell people what is happening, especially because there was no domestic people coming in. And once that route was open, then it was a hit.
Correct. And my question to you is because you are also a developer and a pretty large one, do you see growth still restricted to the top 7 or 8 cities, or are you seeing some kind of a widespread newer cities coming onto the horizon?
Yeah. Well, I mean, I think that there is growth. I would talk about really nowadays top 6 cities. But I think what's happened and is happening in India is, you know, the market is evolving and people are segmenting and specializing. So the days when people feel that they have to be all things to all people, where they have to be in every location and in every vertical and so on, people are becoming wiser about that and saying, I can be more efficient if I focus on a smaller number of specialized markets. So I'm sure that those, as some people call them, second-tier cities, are good markets. But to be able to cover multiple markets, and even to be able to cover in any depth the top 6 cities, frankly, I think nobody yet has managed to do that. And so to go beyond that and to say, okay, I'm going to now embark on going to Jaipur or Ahmedabad and so on, there's definitely opportunity in those cities. But, you know, India is effectively, it's like the continent of Europe. You don't really find people saying, okay, I'm going to be a player in every major city in Europe. So I don't think we need to be. The size of the opportunity is fantastic. And so I think we're moving to a markets that are specialized by geography and by vertical. And I think that's a good thing. And the point that Gautam made about efficiency of capital, scale brings more efficiency, that's good for the investors and so on. So the answer to your question is a yes, but that doesn't mean we all have to be everywhere doing everything.
It is widely believed that if the REIT was to happen in India, you will be the first issuer of it. In the regulations, everything clear now, or is there some more red flags that we need to?
Yeah, so I think, a shout out to APREA and Peter, I just saw come in, who've done a lot of work over the last couple of years working with SEBI and the authorities, but also to SEBI, who've done a great job and been very responsive. They just had a board meeting at the beginning of this week to iron out a few of the final points. There's another consultation meeting, I think, happening in the next few days on one remaining issue. I think, as I heard somebody earlier on say, we're 95% of the way there. It's a complex process. I mean, real estate anywhere in the world, but particularly in India, is a complex asset. And to put it together and package it so that it is clear and transparent and institutional, all those great points that Gautam made, is a complicated process. But I think, yeah, we're all nearly there, both regulatory and from our perspective.
Sharad, you invest in a lot of these private REITs, if I may call. If you were given an opportunity, would you do a REIT, or would you look at the traditional lease rental discountal as a model?
So actually,
as an investor, a large investor and a wholesale investor, what do you prefer?
So we actually don't do private REIT. I think this question should be towards Ambar. They are currently running a fund which do private REITs.
Thanks. No, so I think if from a very selfish personal objective standpoint, any private REIT would want to do a REIT because then the manager's income becomes perpetual. It's not a closed-ended fund anymore, right? So that, from that perspective, yes. But having said that, I think personally, if you ask me, from our stage of evolution as a fund manager, we are at a stage where private investors, large institutional investors are a lot more sophisticated compared to investors at large. And I think we would want to continue with private investments for a little bit, and then when the size is large enough, I mean, look at Mike, he's sitting here. That sort of a size is really what you're talking about from a REIT perspective, because there are a lot of things which are attached to size, unlike any other sector. So when one lease gets over, the other tenant has to come in, and if you are the size of what they are, their existing tenants and the existing relationships that they have with the tenants would come in very handy for you to fill up that space very, very quickly, and so on and so forth. So this is one of the examples I'm giving you of size. So I think from a size perspective, we are some time away from a REIT. But like I said, from a fund management perspective, it's an ideal thing to do a REIT rather than...
And Gautam, you spoke earlier about the positives of REIT. As an investor, what is one thing that is worrying you about Indian REITs?
I mean, I think it really starts with who sets the tone. I mean, if it's going to be Mike's platform and it's embassy Blackstone backed, I mean, we have experience with a lot of Blackstone sponsored REITs globally, and they pretty much ensure that the REIT comes to the market with pretty much a gold standard from a corporate governance perspective. So I guess what Mike does will set the tone for the industry. If the nature of Mike's asset management contract is ensuring certain level of fees for the asset manager and certain level of relative shareholder returns, everyone else has to trend in the same direction. You cannot be worse than that. So that's I feel the first REIT is always going to set the tone, whoever it is. So I'm glad we haven't had any bad REITs. I'm glad no one rushed forward with the REIT product, listed in India, I mean. And I'm glad, if what you're saying is right, that it is going to be backed by a blue chip sponsor. But one thing I want to highlight here is someone on one of the last panels asked, raise your hands if you're excited about India REITs, and everyone raised their hand. And then they said, raise your hand if you're excited about India REITs with a 5% dividend yield. Only I raised my hand. And I think the headline yield is over-marketed by a lot of people in the capital markets, as where there's this inherent assumption that the dividend yield I'm getting from a REIT product should always be X basis points over what my 10-year government bond's gonna pay. You forget growth. If your economy is growing at a certain percentage X, and that's what's gonna ensure the growth in your government bond coupon, your REIT might be growing at 2X or 3X. So that dividend yield is not a static, it's a dynamic. And I hate to give this example, but I'll give it anyways. There's no comparison between India and South Africa. Sorry if there's any South Africans in the room. But South Africa for the longest time has had a REIT market where the REIT yield was well below the government bond yield. And the reason was simple. Investors, whether it's domestic or overseas, had more faith in the corporate credit of a Class A commercial real estate portfolio in the country than that of the government. And that happens. Governments can be BBB rated, but sponsors can be single A rated. So that's pretty much what I'd like to highlight.
So let's ask our friend from Japan, the Genkai, how would you look at investing in India, given that the rate of treasury and the savings in Japan is 0 or negative. Okay, so anything that is even 5.
No, I would.
He raised one hand. You
invest.
could raise both your hands.
Well, I'm the only one. I came here 2 years ago on same conference, talk about this, how zero cost of capital should come in this country with the growth. I still believe in this, but it's difficult. I spent 2 years understanding this country, the culture and management and people, market itself, different practice. Then if I talk with the institutional investor, it's gonna be more difficult. So, but personally, I will buy in because of the growth. I mean, Japan, if you buy Japanese government bond, yield is almost 0, 10 years. Can you believe it? 0. So the problem is all the Japanese pension or big institution had a lot of government bond held coming back on the maturity. There's no way to reinvest in the same thing. It's 0 or minus. So they suddenly start looking some other alternative investment, and they're actually big into US, in real estate US, infra. And India is a next phase. But the difficulty of India is, as I said, I myself believe in this country and try to start the investment private fund. But, this difficulty of understanding is a little bit of, we have to overcome for institution to buy. But in terms of REIT, because the REIT is very well not taken in Japanese market, and also REIT is almost like a stock investment. They can sell if they want to. I'm sure some of your clients, Japanese clients, may participate through these people, which is gonna. But one thing everybody, my investor, asks is the currency risk, which is something we normally have to reduce 4-5% yield. That is a challenge I have to face.
So we have enough of time to go to the audience and ask them if they have any questions for any of the panel members.
Can I ask a question?
Yeah, sure.
Sorry, I was not in the preliminary meeting, so I have a question about the Indian REIT. Is there conflict of interest of REIT and a sponsor? How is it taken care of? In case of Japan, as I said, big corporation like Mitsui, they create their own REIT. And Mitsui is the largest developer, like Embassy maybe. The Mitsui actually sell their own office building to their own REIT. And their REIT managers are seconded by the sponsor. So it's, as a manager, it's really difficult how to gauge this conflict of interest. Yeah. But Japanese REIT is doing good. Even in this conflict, they manage it with the disclosure, or their market will gauge you all the time. I don't know how this will be.
Yeah, I think that's a great question. I was talking to Gautam about this earlier on, who's got more experience internationally. I'll just comment on where we're at on that. So the REIT regulations structure such that there's the sponsor brings the trust to market, and there's an appointed independent manager. So that's the company that I represent. It's an external manager. It is jointly owned by the proposed REIT, but there are a number of independent directors, and there are requirements in terms of reporting and corporate governance that are set out by SEBI. Our management company is a completely separate entity to the sponsor. So, but it's absolutely spot on. That's a key issue that needs to be unpacked and addressed. Gautam, do you want to comment on that? Because that's an area.
I think that's a good point. 99% of the REITs in the United States are internally managed. The US REIT market does not like the structure of external management because there's a lot of conflicts. Like in Japan, for the longest times, The developers were developing the assets and then selling them into the REIT at a predetermined valuation. So I'm basically the REIT shareholder sitting here waiting for the sponsor to set something as a price and sell it to me at an expensive price, and I'm funding that. No one really wants that. So in the United States, this model is not working, does not work. But there's a reason for that. It's a mature market. Mexican REITs, the first Mexican REIT launched in 2013. You see, there's no option but to go ahead with the external advisory structure at the get-go. Otherwise, there's no incentive created for the external advisor and majority shareholder to bring these assets public. You don't want to lose control right away. You want to test the market. You want to have an option. You want to see it work. You want to test the market for your cost of capital. But over time, you need to have a path towards internalization, because as the market matures and as shareholders accept your investment strategy, as your cost of capital has been determined, now you got to realize you don't fall into the Japanese REIT experiment trap where people would view the sponsor as not contributing the best assets to the REIT or not doing the right things with the REIT. So I gave the Mexican example and then I diverged. Mexican REITs all came out with an externally advised structure. They're still externally advised. Look at the stock price performance of Mexican REITs relative to Mexican equities, global real estate equities, and just overall on an absolute return basis. And you'll see what I'm talking about. It was important that these guys came public, and it was the right incentive for the external advisor to have the externally managed structure, because that's the only way you institutionalize the real estate market. How else are you gonna introduce your real estate on this global platform that's well recognized? Over time, a lot of these Mexican REITs started making amendments to their asset management contract with the sponsor. They reduced the level of fees, they got rid of a number of fee layers, and I believe that as that market matures, which could be another 5 years once it's had a 10-year track record, you won't see the external sponsor anymore. And that's when the external sponsor could go away through a predetermined contractual agreement. That's where the external sponsor could be bought into the REIT and the REIT becomes internally organized. Or there could be an open auction where, you know, the REIT has the option to terminate the external sponsor agreement and pretty much hire its own executives.
I'll just add the concern that has been raised on conflict of interest. In India, in last 10 years, there have been a lot of development firms which have gone public. And if you pick up their track record of last 12, 13 years, they have done massive destruction of capital. So if to the same public market, one more product going in where the control lies with the developer, there could be a lot of skepticism towards that.
Well, good. If there is no other questions, we would like to call it the end of the session. And I would like to thank each one of the panel members for participating and making this debate very live and encouraging. Thank you very much.
Thank you. Could we request the panelists and the moderator to step a little in front for a photograph? Thank you. And ladies and gentlemen, it gives me immense pleasure to welcome Mr. K.B. Gupta, the Housing Commissioner, Rajasthan Housing Board. Thank you very much for gracing the occasion, sir. Could we also request Mr. K.B. Gupta to be on stage and present a token of appreciation to our moderator, Mr. Atul Mehra. Could I request the panelists to kindly stay back on stage? Ladies and gentlemen, please join me in welcoming Mr. K.B. Gupta, Housing Commissioner, Rajasthan Housing Board. Thank you very much. If you could present Mr. Atul Mehra with a token of appreciation. And can we request Mr. Chalapati Rao, the Governing Council member, to present a bouquet to Mr. K.B. Gupta? Mr. Gupta, if you could please stay back on stage for a moment. May we request Mr. Neeraj Kamdar to join us on stage and present a token of appreciation to Mr. Mike Holland. May we request Brigadier R.R. Singh, the Director General NAREDCO, to kindly come up on stage and present Mr. Masatoshi Matsuo with a token of appreciation. May we request Mr. Rohit Podar, Joint Treasurer, NAREDCO Maharashtra, to join us on stage and present a token of appreciation to Mr. Sudhir Hoshing. Requesting Mr. Anil Shah, the committee member NAREDCO Maharashtra, to join us on stage and present Mr. Ambar Maheshwari with a memento. And we request Ms. Tara Subramaniam to join us on stage and present a token of appreciation to Mr. Gautam Garg. Requesting Mr. Maulik Dave to join us on stage to present a token of appreciation to Mr. Sharad Mittal. And last but not the least, it's a pleasure to invite Mr. Sumit Agarwal from the Hiranandani Group to join us on stage and present a token of appreciation to Mr. Ashish Shah. Mr. Sumit Agarwal, sir, pleasure. Thank you, gentlemen. Ladies and gentlemen, could you please join me in thanking the wonderful panelists and the moderator for the session. Thank you very, very much.